Gentlemen, how are we?
Good. How are you?
I'm doing
Feeling
great.
good.
Derek, Ryan, you guys doing well?
Yeah.
Doing great. Another month passed.
You better believe it.
Made it through October, day before the election.
That we are recording this because we are going to touch some of these points that we've been waiting on for a while.
Right.
So this is before the election results.
Yeah.
October.
Before we get into that, Ryan, Halloween.
Yeah.
Let's
You know
what were
what,
the kids
right.
wearing? What were we
What'd you dress
doing?
up as?
What did you
Me,
dress
I
up
actually
as?
threw on a Red Wings jersey, and I was the hockey player that it's just the easy go-to. But I had Connor, my 5-year-old boy, was a, what was he? He was a wizard. And then Riley was like a spider of some sort. My wife, Amber, made the costume. So
Oh, perfect.
Just show up, right?
it was
It's
good.
like
Right.
your birthday.
Oh, yeah.
We ended up with the Peter Pan theme. So
good for
that
you.
was Smee
All right.
this year.
Good.
But, yeah.
Well, let's stick with the October
Yeah,
theme.
let's go back to the market.
Yeah.
Ryan,
Yep.
markets, October, how do they look?
So we always like to check in, two major indices that represent cornerstones of any really retiree's portfolio. Somebody who's still out there working or somebody who just loves risk, you're going to want to focus on the S&P 500. Top 500 companies in the U.S. as measured by market capitalization. The month of October was tough. Kind of a scary trick or treat, if you will.
There
But
we go.
anyway, S&P 500 pulled back less than 1%, 0.91% to the downside. The aggregate bond index, which is going to be, again, that basket diversified bond index that we like to just gauge for the market sentiment for the month, was actually down more. It was down 2.48%, so not quite 2.5%. It was a tough month for bonds, and there's some reasons why, which we're going to get into here shortly.
Yeah. Well, let's jump right into that.
Well, and again, we got this backdrop of, more volatility in the markets. How does that impact the portfolio? What were we doing in the month of October to...
Right. So volatility is a really good word that we toss around to represent deviation and bumping around in price. I mean, let's just boil it down to that, price movement. And volatility is indicative of a market that's trying to find a baseline. So I think what you're doing is as you're bumping up towards this catalyst of the election, you're seeing a market who doesn't really know where it wants to go. But we have seen a few things over the last couple months that is driving a certain narrative or theme that did not relax. And that theme continues to be as brought to you by inflation. We've talked about this for months and months and months. So we saw in September Fed interest rate cut, and all of a sudden interest rates just dive. Okay, why was that not durable? Why did bonds take the beating that they did in the month of October?
Right.
Bonds don't trust the policymakers right here. In my opinion, and I think that October would be the evidence to support, but clearly nobody thinks that inflation is put to bed. And that's why you're seeing market-driven interest rates lifting higher. And so it's this idea that as rates go higher, you're able to, that's how policymakers would control inflation, would take money supply down. And certainly the Fed gets to set the Fed funds rate. It's the shortest rate that we kind of see published out there. But then the rest of the interest rate, the yield curve, it's really a market-driven environment. And so I think one of the things that market participants are looking at is that M2 money supply. And we've talked about that before here. How many dollars are out there in the world? And let's just revisit it in its most basic forms. Let's say I like eating M&Ms. I have a jar of M&Ms. I could just sit there and eat those M&Ms all day long because I've got a jar of them. I've got an abundance of them. But if I only had 3 M&Ms, well, I better very well want one if I'm going to eat one because I've only got 2 left if I eat one. So it's fair to say that scarcity creates value. Abundance decreases value. Now replace the M&Ms with dollars. That's what we're talking about here. So how do we take that inventory down, if you will? Well, there's a couple things that can play out here, and cutting rates is not one of them. So I think what's happened here is we've got this issue of such an abundance of dollars out there and really no signs of slowing down. I mean, deficit spending at that congressional level will continue to drive that. So again, this isn't new to history, by the way. There are times throughout history where we thought, okay, maybe we're seeing the inflation fight is done, and it's really not. So I think, number one, historical high levels of M2 money supply. And I watched the chart. I mean, we watched the chart. It's really monthly kind of check-in, but still, you can keep an eye on it, right? So that dollar is really challenging the interest rate market, which then challenges the bond market. So we've done things in portfolios to engage opportunities there, and this is for mainly retirees, right? Those who are looking for that management style that'll get you through retirement where you can take a distribution out. Well, one of the cornerstones of that type of portfolio traditionally would be bonds, but you've got to be very careful what types of bonds you own in that space.
Right.
And this isn't something new to us. So from a portfolio update perspective, we never concentrated anything to hook up to that just interest rate, like this idea interest rates would collapse here.
Right.
So we're faring pretty well and really haven't had to do much around the edges, around the margins. But I can tell you, keep in mind, the M2 money supply, the money supply issue. Well, what about this? Take XYZ company and it say, revenue was flat, but the stock price is up 30%. Well, it's not that that business got any more valuable. It's that the dollar got less valuable. And so it takes more dollars to get that asset, right? So when you think about inflation from the stock side of things, as long as you hold assets, it's your best friend.
Yeah, you're gonna rise.
Right, but societally speaking, those who hold assets are typically the wealthier. Those who do not, they're really kind of left to just eat the inflation, which is very challenging, and it's a social problem.
No question.
Yeah.
So if we're looking at, the markets in October, kind of how we looked at the portfolios and what really caused a lot of we'll say the short-term stuff in October, let's change gears a little bit because we do have the election,
Yeah.
right? So, how should or are we or should we, position a portfolio in a certain way?
Yeah.
What are we doing? What are people doing?
Yeah, well, we've been getting the calls,
Right.
Right.
But then just look at the temperature of the nation. And let's say that it's a coin flip at this point as to who's going to win or not. What that tells you is there's equal representation essentially on either side.
Yeah.
Equal representation for either candidate. You've probably had the calls.
Yeah,
You've probably had the calls,
Yeah, I
right?
have.
From both sides. So in order for everything to collapse, which I think is everyone's greatest fear, and mind you, your imagination oftentimes is your greatest enemy to wealth creation,
Yeah.
your imagination. So the idea is that it collapses if my candidate doesn't win. Well, I'm here to tell you, somebody already called with the exact
We said-
opposite.
we had the same
right?
conversation on
So
both
in
sides.
order for things to completely collapse, everyone has to sell, right?
So are you saying, Ryan, we have buyers and sellers on both sides?
Yeah, go figure.
Yeah.
Equal representation.
Right.
Yeah.
So-
Usually lends itself to a functioning market too.
Right. So if we see that half are buyers and half are sellers in any scenario, right? If we are saying it's kind of a coin flip or 50-50, could we maybe look at it as we have an election tomorrow, we've got, whatever's going to happen is going to happen. Would we say that half the country might be looking to stay in the market or get into the market?
I don't know. Do they have a good financial advisor or asset manager working
That's
for
right.
them?
Yeah.
Right? I mean, go ahead. Share your perspective on it.
Well, when we've talked about it, we do make the comment, okay, so let's say that X or Y happens. And half the country is going to be excited.
Yeah.
And maybe the other half is a little more nervous. But then if you have people like us that are trying to take those emotions out, you might have another 25% of the country that our job as advisors is to try to help them stay in the market. How do we find value in that market and whatever that scenario is?
Right.
So it's not like you just said, half of it collapsing, right?
And you point out, the reason that I wanted you to bring that to our audience is because it's just very intellectually smart to say, because that's one of the ways we add value.
Right.
We take the emotion out of it.
Yeah.
So what you're saying is the 50% that would sell because their candidate didn't get elected, well, hopefully they make a few phone calls and have somebody that they trust working for them, because that's probably not the right way to make a decision about your invested assets. It's one of the ways that we add value. And you can kind of look at all of these ways, that being a pretty powerful one.
Yeah.
Yeah.
Removing that emotion.
Yeah.
Removing
Yeah,
that
removing the
emotion, and that's kind of where we like to step in.
Yeah.
You know?
But I think also one thing that our audience needs to hear is the outcome will be what it will be, and this is such a close race that, remember, just as much as you have those really strong feelings about your candidate, there are others who have very strong feelings about theirs too. So try to understand that your feelings are right for you, but they might not necessarily be the temperature of the nation.
Yeah. Right?
So
CEOs still have to manage their businesses according to whoever gets elected.
Yeah.
Right? And so whether Donald Trump gets elected or Kamala Harris gets elected, they still have a business to run, and they want that business to remain profitable.
Yeah.
So
So
what
we
you're
decide whether we want to buy it or not.
It's not
We get to make that
absolute
choice.
power coming from the presidency,
Yeah.
and I think that's kind of where we're going with this, right?
Right.
So that there's a lot of players, even at that political and policy making level. I mean, there's a whole Congress that we empower to make sure that there are checks and balances. So to that end, don't let those very powerful emotions overwhelm like the system that is in place.
Right.
And understand that very good and talented CEOs will continue to lead and propel their businesses into new growth modes and find different opportunities out there. Because remember, and this is really important to always remember, when you buy a stock, you own a company.
Yes.
It is truly that ownership representation that when you buy, it's not a popularity contest. It's not you get up and spin a wheel and see what number you land on. No, you truly own a business.
Right.
So again, understand that as we kind of transcend through volatile times, whether it's this time or sometime into the future, that is a very valuable lesson to understand that you own a business. And those businesses are driven by different leaderships. They're not all driven by the President of the United States.
Right. And it's, again, important to know, like you said, the president doesn't have absolute power.
No.
And we don't need to get into a history lesson. We don't need to bring in our, high school civics teacher to go through that. We'll keep it with the water talk, the water cooler talk, But again, there's going to be a decision made, tomorrow or hopefully very soon thereafter.
Right.
What are the outcome trades that we're looking at?
Yeah.
How are we, what are we doing once the election's decided?
Well, first of all, it would be very nice, I think, for the markets if the election was pretty decisive and had, a clear winner.
Right.
The sooner the better.
Right.
Markets hate uncertainty, so be prepared if it does drag out for a little while. Markets probably will not like that. But what you're asking for are the outcome trades.
Right.
That's where all of a sudden we perk up. Rather than the emotional coaching, it's more the opportunity seeking that we love, right? So when you really step back, there are some opportunities out there. For instance, you kind of know what you would get with not necessarily an incumbent win, but a continued along this democratic, outcome. We already kind of know that playbook,
Right.
and we can anticipate perhaps some things with taxes and whatnot. But then, if we do get a change around on how things are being done, I mean, you've heard the word tariff talked about a little bit,
Right.
okay? Well, one of the things that would lend itself to would be perhaps a stronger dollar, but if offset with a lower tax regime, that might dampen kind of those effects. So you might also in that environment where you do have barriers to entry from our economy, and we'll get into this once we do have an outcome.
As we start to kind of roll through
right?
different
But
ones.
you might be a little bit hesitant, or you may reduce foreign exposure, something like that. So I guess where we're going with this is just the opportunities that will come from this. You can't just dismiss them and say, well, it is what it is, it's the market. No, there are some opportunities here, but it's on the margin.
Yeah.
It's gaining our edge, and that's where we can really help our clients.
And once again, we say it quite often. That's why we're here.
Yeah.
And we're on it. We really could just have a one-topic podcast.
Yeah,
and say,
yeah,
right
yeah,
here,
absolutely.
we're on it.
Absolutely, absolutely.
We've kind of touched on, what we're looking ahead toward, right?
Right.
Very near future, but, as we see these outcomes, I mean, what are some specific things that maybe you're looking at as far as portfolio setups, into the near future?
Quite frankly, the market, take all of this aside, the market looks pretty well set up here. I mean, I'm seeing some very, very encouraging signs. Quite frankly, it doesn't matter who wins the election. Because again, we've kind of talked about that, and we won't keep beating this this topic, but the bottom line is, you look around, you look at big money positioning, you look at the charts out there, you look at that money supply. I mean, all of those things create a really nice environment, and guess what? If you can get past this catalyst, that is the election, that's breeding uncertainty, all of a sudden, you have a really powerful setup.
Right.
What do we do with it? Well, I don't know. We'll see next month. But
That's right.
the bottom line is, things are looking very constructive. And so I think if we can get the country past this big event, all of a sudden, and get it settled, bring it home, then I think we're on a nice platform to kind of lift off from.
Yeah, can't do that.
Yeah. So, and again, we're not making a ton of portfolio movements or anything like that right now because it would make sense to see what we're dealing with.
It'll be okay.
Going forward. Yeah. Oh, that's great. Say that again.
I was just going to say, either way, it'll be okay.
It'll be okay because we've been here before.
Yep.
And this feels like the most important election ever. I get it. It does always, right? But
I think we actually started the podcast heading into what was going
could
to
have
be,
been.
you know,
I think
kind of in that
it
time
was
frame.
2020, right?
Yeah.
So
Right.
anyway, now it'll be okay. And guess what? We're here. We're here watching.
right.
We'll see you next month.
Absolutely.
All right. Thank you.
Yeah.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.